Okay, ladies and gentlemen, welcome to our discussion on lease accounting and topic 842 for financial statement analysis. Well, why are we looking at this now? This came out back in 2016. So February 26, FASB issued ASC 842. We can see when I first issued it was in January of 16. GASB issued in 17. Now, that was a couple years ago. So why all of a sudden is it becoming important? Well, IFRS for all companies, ASC 842 for public companies only, was effective beginning January 1st. So we're starting 2019. So those companies that have a 12/31/2019 calendar year, we're going to start to see the impact of that. For private companies and under GASB, it's going to be January 1st, 2020. So we won't see that until 21. But for what we're looking at for financial statement analysis, these are going to start to come into place. Now, what does that really mean? Well, to understand it, there's really what we call a financial lease versus an operating lease. These are the two types of leases that come into play. Previously, they called them capital leases and operating lease. So the first thing is we have a little terminology change. Under the current accounting, or the prior accounting, we had operating and capital, and operating leases were kept off the balance sheet by the lessee, and capital leases we put on the balance sheet. Okay, so that's what we did in the past, meaning it was on the balance sheet as an asset and a liability if it were a capital lease, and if it was an operating lease, we just expensed it as rental payments. Now let's look at what's the old ASC 840 versus ASC 842. The first thing is there were four we'll call red line criteria. And these are the criteria that said if this happened, then that. There was operating versus capital, and only capital has a balance sheet impact. Okay? The old four criteria, they've added a new one, so there's now 5. And they removed the red lines. And there's a little space in here that judgment is needed. Also breaks it down to short-term leases, less than 12 months, operating versus financing. Now, both operating and financing have a balance sheet impact. Okay, so it's the criteria of determining what a lease is finance versus operating. It distinguishes the short term, and now both the operating and financing have a balance sheet impact. There's also additional disclosures so users can make more sense of it and understand what the liabilities are at the time. Under current rules, past 10, well, it's current, Topic 840 and FAS 13, it's a capital lease if you transfer ownership to the lessee at the end of the term. Contains a bargain purchase option. A lease term equals 75% or more of the estimated economic life. And the present value of the minimum lease payment equals or exceeds 90% of the fair value. Now, 75 and 90 are sort of the red lines that if you went over or under would make a difference. So now, under the new rule, application of the new rule, let's use that word, application of the new rule, you still have transfer of ownership to lessee at end of term. Instead of a bargain purchase price that the lessee is reasonably certain to exercise. Okay? Lease term is for the major part of the remaining economic life. It doesn't specify the 75, but again, this is the judgment that's coming in. The present value of the lease payment equals or exceeds substantially all of the fair value. Again, got rid of that red line. The next one is the new one, and I think this is one to be aware of. The underlying asset is such a specialized nature that the lessee is using it that it's expected to have no alternative use to the lessor at the end of the term. So those are the rules when we look at a capital lease versus a finance lease. So here's sort of the questions we go through. If you're looking at this as sort of a walk down, so does, get the cursor here, does the underlying asset transfer ownership? Yes, becomes a finance lease. No, we go to the next question. Is there an option? That likely? Yes, financing. No, keep going. Is the lease term for the major part of the remaining economic life of the asset? Yes. Is the present value of lease payments plus any guaranteed residual value greater or equal to substantially all of the fair market value? Yes, it's finance. No, keep going. Is the asset specialized to the extent that it's only useful to the lessee? Yes, it's finance lease. No, it's operating. So we're going through this, and this is sort of the questions in the sequence that companies have to go through. Some terms that are new here, ROU, right of use asset, meaning that you have the right to use it. So this term is relatively new also, ROU, and you refer to it as the lease liability. The other term is short-term lease, less than 12 months. So if we take a look at that, this is where we come back that it was issued in February of 2016. But here's what it looks like. On finance leases, if we look at the balance sheet, income statement of cash flows, they're substantially the same as capital lease or finance. What ended up happening is there's probably a few more transactions that folks considered in operating lease that now would be finance. So in the determination of what is a capital or finance, when we look at operating leases, from an income statement and cash flow, they're substantially the same as an operating lease when we look at GAAP. Okay? Big changes, it's recognized on the balance sheet. And if we look at how this lays out, the lease liability and then the subsequent measurement and remeasurement of that is the present value of the unpaid lease payments. So lease liability equals the present value of unpaid lease payments. That means we have to pick a interest rate to discount them back by. Okay? And that's the lessor's implicit rate if it's available. Otherwise, it's the lessee's incremental borrowing rate. So in these changing times of low interest rate, we could have some things happening in there. What is the ROU? Okay. Initial measurement, again. Lease liability. So it's working backwards, if you think. Plus the initial direct costs, if you had to spend. Did you make any payments up front? Did you get any incentives? Okay. So when we're looking at it, this is a different way of computing it. That the ROU asset is that present value. So it starts out equal, except when you adjust these. Okay. We then move into disclosures, and it expanded the qualitative and quantitative disclosures. Intention is to enable financial statement users to assess give us more sense of what's going on with the cash flow from leases. So this disclosure, which we're now seeing in financial statements, is what is the lease, but it's based, again, on judgments and assumptions. It's got to show a maturity table, and it's to give us a better sense of what the cash flow requirements will be in the future. And as we remember that the value of a company, its ability to generate future cash flow, this becomes important. In a very simple way, if we look at it in a debit and credit, and some of you love debits and credits as I know, is that the debit is to ROU asset, and that's the lease liability plus the direct costs, plus any payments that you've made, less incentives. And the lease liability is the present value of unpaid lease payments. So why this is coming in, when we look at it, some companies, you really have three choices. you can just apply it currently. So for the current reporting year, retrospectively, meaning you would go back and restate prior years, and prospectively in the future. So that's this was before. We now know what is as to when it is. So everybody now has to report it currently or retrospectively. Prospectively, unless you're a private company, would be in the future at this moment. What we look at ratios a little bit, and I think what this is one that you want to take into account is it essentially is looking at what are some of the solvency or leverage ratios, debt ratios. And as we can see, long-term debt to equity with an operating lease is going to cause it to go up. So now that we have more leases, we're going to include these lease obligations, both current portion and long-term. We are going to include that in our computation. So that will cause an increase if we just sort of ignore the finance, because that's always been there. But this is what's new, this right here. So it's going to increase leverage, total debt, debt to equity, long-term debt to equity. So this is what we're going to be seeing. Now, to give you a better understanding of this, I have put out there 2 videos for you to take a look at. They're included on this page, and I do encourage you to look at them. This will be a question on the next quiz. If you have any questions, please don't hesitate